Go.
Okay, we're on page 13 of chapter 7. I think the rest of the chapter was clear, but I just wanted to go through the comprehensive problem. So if you go to page 14, and I sent you the lecture material, so you should have all these numbers, but just to tell you where they came from, your sales are all on page 13. So it breaks them up from December to April. So in January, for example, we had 240,000 of sales. We collect 75% in cash, the other 25% are on credit. The 25% on credit is always collected in the next month. So if you look at January, 240,000 times 75% is 180,000. 240,000 times 25% is 60,000. February, 250,000 times 75% is the 187.5. 250,000 times 25% is 62.5. And for March, 275,000 times the 75% is 206,250. 275,000 times the 25% is 68,750. Next, we're going to look at our actual cash collections. So we're going to collect cash from our current month sales, right? Those that we made for cash. And then we're going to collect the cash from the previous month's credit sales. So in the month of January, we already know our cash sales, they were 180,000. So we can just move those down. Those are for our current month cash sales. In the month of December, if you look on page 13, we had 200,000 in sales. 25% of those would have been on credit, so 25% of the 200,000 is our 50,000. And you just add the two up to get the total. February, we know our cash sales for February were 187.5. We can bring that down. The credit sales from January, which we're collecting in February, are 60. Add the two together, you get 247.5. For March, our cash sales are 206. The cash sales we're collecting from the credit sales from February are 62.5. Add the two together, it's 268,750. Our accounts receivable balance at March 31st is the credit sales for March. That's 68,750. Okay, so let's look at our inventory purchases. First of all, they tell us, again on page 13, they tell us that the company's gross profit margin is 40% of sales. So remember, revenues minus cost of sales or cost of goods sold gives us gross profit. So gross profit is 40%. Revenues are 100%. Cost of sales must be 60%. So we know our cost of sales is 60%. The other thing they tell us is on number 5, page 13, at the end of each month, inventory on hand should be equal to 60% of the following month's sales needs stated at cost. So let's go through this. First of all, our budgeted cost of sales for the month of January is our 240,000 times 60%. That's 144,000. Our desired ending inventory, we have to look, this is what we want to have at the end of January. It's going to be our February sales, 250,000 times 60%. That's our cost of sales. And then we want to keep 60% of that on hand. So that will end up being, it'll end up being 250,000 times 60% times 60%. It's just a coincidence that the 60% cost of sales and the desired ending inventory, 60% is the same. But we add these two figures together and that gives us our inventory needs, and then we subtract our beginning inventory. Our beginning inventory is given, if you look on page 13, and you look at inventory, it shows it's 86.4. We could have figured it out because this would have been our ending inventory at December, right? So if you looked at December, at that point in time, they would have been looking at January sales to determine ending inventory. So they would have looked at 240,000 times 60% times 60%. Either way, you'll get the same figure. And the purchase totals are given. So the purchase total here is 147.6. Okay, February, we're going to take our 250,000, multiply it by 60%, and we get 150,000. Our ending inventory that we want is going to be our March sales, 275,000 times 60%. That's our cost of sales. We want to have 60% of that on hand, so we multiply that by 60%. So if you took 275 times 60% times 60%, you would get 99,000. Add the two together, you get 249,000. We're going to subtract our beginning inventory. Beginning inventory for February, it's the same as your ending inventory for the previous period. So it's the same as your ending inventory for January. So it's 90,000. March, if we took the 275 times 60%, we get 165. If we took what we want in ending inventory, we'd have to look back on page 13 for our April sales, which are 260,000. So that would be 260,000 times 60% times 60%, which would give us 93.6. Add the two together, we get 258.6. Again, we have to subtract our beginning inventory, which is our ending inventory for the previous period. And then that gives us a total, which is given 159.6. For these totals, for budgeted cost of sales, you would add across. For desired ending inventory, you take the ending inventory for the last month, because that's your ending inventory for the period, 93.6, and then you'd add the two together. For your beginning inventory, you take the beginning inventory for the period, which is January, and that's what you're subtracting to get your total inventory. Okay, we're going to move on to the next page, page 15. Okay, now we're going to go over our cash payments. I put up the required purchases that we just determined for January, February, and March. If you go back to page 13, number 6, they tell us 30% of a month's inventory purchases are paid for in the month of purchase, remainder is paid for the next month. So, if we took the 147.6 from January and multiplied that by 30%, we would get 44,280. The 102 is coming from accounts payable on page 13 in the balance sheet. And then we would add the two together for our total. For February, we're going to have our February purchases at 159,000 that we're paying at 30%, which is the 47.7, and 70% of the January purchases. So the 147,600 multiplied by the 70% is 103,320. And again, you would just total all of these. They are totaled in the book. Then for March, we have from our February purchases 159,000 times 70%, which is the 111,300, and 30% times the 159,600, which is 47,880. And we would just total that. Our accounts payable balance on March 31st is the 159,600 multiplied by 30%, which is 111,720. Now onto our schedule of cash payments. This is also given in page 13. They tell us all of our various payments in number 4. Our monthly expenses for salaries and wages are $14,000 each month. For advertising, it's $25,000 each month. For shipping, it is 5% of sales. So for example, our sales in January are $240,000. $240,000 times 5% is $12,000. Sales in February are $250,000. $250,000 times 5% is $12,500. Sales for March are $275,000. $275,000 times 5% is $13,750. Our other expenses are 15% of sales. Same way, 15% of 240,000 is 36,000. 15% of 250,000 is 37,500, and 15% of 275,000 is 41,250. And then we're going to just add those all together. Okay, so now we're going to move on to the next page, page 16.